Hi everyone, this is Jason Burack. Instead of doing an interview today, what I wanted to do was just a special video for our subscribers to our channel. Not going to be interviewing a guest. We have a lot of people here interested in value investing, so I want to go over one of the core principles of value investing, something most astute value investors, experienced ones who consider themselves value investors should know, and that is the value trap. So we're going to look at a case study here. And I think McDonald's is a pretty good one in terms of a value trap. So first, let's look at the definition of a value trap. So Warren Buffett, Benjamin Graham, these are some of the early guys who started value investing. Well, Benjamin Graham was the father. I consider Benjamin Graham basically Yoda in terms of value investors. And Warren Buffett is mostly Benjamin Graham, but he's read Philip Fisher. Common Stocks, Uncommon Profits, I believe. And he's read other value investing and other methodologies, and he's tweaked things Warren Buffett has. But the general definition I would consider of a value trap is a company where the numbers, and we'll take a look here on the screen at McDonald's, where it may look fairly cheap if you look at some of the basic numbers, but it's just a trap because their underlying fundamentals in the business, their brand, their durable competitive advantage, as Warren Buffett would say, their moat, their consumer monopoly is drastically crumbling. So, McDonald's right now, they're actually close to a 52-week high, believe it or not, and that's despite store closings and them not hitting their numbers. I guess the market is just that desperate for any type of dividend in this environment. But they have a 3.5% dividend yield approximately. They're trading around 22 times earnings right now. Their forward PE ratio, according to forward earnings, is around 19. So for this market, they're kind of in line with the Coca-Colas and some of the other dividend stuff. But this is the company is restructuring right now. They're going through. They're not in bankruptcy debt, but they're trying to drastically change what they've been doing for a while, and it's because they basically destroyed their brand, or they're in the process of destroying their brand. And let me lay out some things for why I think they're destroying their brand. For those of you who've eaten at McDonald's, and you've seen the documentaries out there like Super Size Me and so many more, there's a lot of stories out from health experts that McDonald's has been cutting a lot of their corners. They've been drastically using chemicals in food. They haven't been using, organic chicken. They haven't been, when they make French fries, it's not really rocket science to make good French fries. In order to make a good French fry, you need a quality potato, some salt, maybe some extra seasoning there. If you're going to get fancy, you can keep the skin on the potato. You got to double fry the fry to make it crispy. It's not rocket science to make a really good tasting French fry. Same thing with a good quality burger and some of the other stuff. And McDonald's for a while, for the last number of decades, they've just been, I guess, cutting corners, and most people didn't know about it till the documentaries and the stories came out. And there's been stories of them, putting pink slime in hamburgers. They've put massive amounts of chemicals and preservatives in their meat, in their French fry. Their French fry, it's basically just now, it's not fresh. Like many other restaurants do now. It's frozen potatoes, but God knows the other preservatives and all that stuff, and I think there's stories out. And there was also the story out about how, the McDonald's burger, one of them was just kept in a drawer or something for years, and it didn't look like it had aged that much. So it's and real food isn't supposed to do that. It's supposed to rot very quickly. So there's obviously lack of nutrition in their food. Their food is dangerous. There's many chemicals and everything. They're in the process of destroying their brand. And in general, I would say there's millions of American consumers. Maybe foreign consumers aren't as savvy about this yet in terms of McDonald's, but there's millions of American consumers who don't trust their brand anymore, who don't trust their food. There's so many other options. There's fast casual dining like Chipotle, and there's so many other burger joints available. I live right around the Tyson's Corner Mall, which is one of the largest malls in the United States. And there is a McDonald's in this Tyson's Corner Mall, but there's also 6 or 7 at least other fast casual burger places that offer, dry aged beef burgers with fresh made fries that were fresh, or grass fed beef burgers. these places are Elevation Burger, which is a publicly traded chain, I believe, Shake Shack, BGR, which is a local chain, and then there's Five Guys, which is a mostly East Coast burger chain that has, fresh fries and fresh burgers and stuff. And when the consumer is around and they're able to choose with competition for only a couple more dollars for a much healthier burger that's either grass-fed beef or, dry aged beef, the quality is going to be there and the food's going to be fresh. They're not going to choose McDonald's for only a couple more dollars. They're going to go eat something healthier that they know tastes better and was made fresh. So McDonald's has a lot of work to do to rebuild their brand. They have a lot of money, obviously. They have, billions of dollars. They've spent billions of dollars in advertising. So they do have the ability, they have the resources to turn things around. The question is, how long is it going to take them to gain consumers' trust again? And you know what? This is a long and very expensive process and road that they're going to be going down because they've burned consumers for so long. Very high calorie food that has a lot of corn products and high fructose corn syrup and so many other bad additives in them. So in terms of that, McDonald's used to, guys, give you a little back history on McDonald's if you don't want to go watch a McDonald's documentary. But basically, right after World War II, McDonald's had essentially a consumer monopoly on a lot of fast food for a while, and that's because they were one of the few restaurants that was able to put so many locations at around each stop on the national highway system. So, there was specific hotel chains that had monopolies on the national highway system as President Eisenhower was ordering it built. It was partially, there were multiple reasons for the national highway system, for Cold War protective, so there could be airplanes landed on it, but also so the country could be connected and there could be more consumers and more goods move more easily, move back and forth. It was a copy, I guess, of the German Autobahn. But anyways, though, guys, McDonald's essentially had the rights to the restaurants on the national highway system at the rest stops. They were one of the few restaurants there. And back in those days, there wasn't a Yelp. There wasn't a way of being able to test out or get reviews on local restaurants that were off the rest stops in the national highway system. So the consumers couldn't go to their smartphone. They couldn't look up the Yelp reviews of the local restaurant at their stop and check to see if there's food poisoning or the food's made out of the microwave or it's all frozen or anything like that, like there is now. So back then, people were a lot more apprehensive of trying new restaurants unless they got a recommendation from a friend or stuff, especially if they were traveling. So people trusted McDonald's a lot more back then. And I'm sure back then McDonald's, when they were originally starting, they were kind of more like In-N-Out, where they're using a lot more higher quality ingredients. But, McDonald's, I guess, like a lot of other food companies, they switched to the model where they just want to cut corners, lower costs. They substituted out a lot of quality ingredients. We've seen that too in a lot of the other larger food companies that are not fast food like McDonald's, but the other larger food companies have done this for decades as well. In terms of that, McDonald's used to use high-quality ingredients, billions in advertising. McDonald's now is a victim. They do not have what Warren Buffett would say is the durable competitive advantage. They don't have a large economic moat. They don't have a consumer monopoly anymore. Decades ago, okay, maybe they did. But now there's just so much more competition, especially in the United States, with Chipotle and so many more of these fast casual burger places where for only a couple more dollars you can get a much higher quality burger in your area than McDonald's. And it's pretty ironic, though, guys, that Chipotle is basically kicking McDonald's butt now because McDonald's was one of the early investors in Chipotle that helped scale up Chipotle and build a lot more Chipotles. And McDonald's sold all their shares in Chipotle, I believe. So, at a lot of Chipotle guys, obviously the valuation on Chipotle is not good. It's growing like crazy, though. But there's, from a real-world perspective for a restaurant, one of the things you want to see if it's a fast casual or fast food is that there's long lines at lunchtime and dinner time and stuff. And Chipotle, to a large extent, unless they put too many stores in around the same location that are too close to each other, there are a lot of long lines. So maybe those customers that used to go to Subway or McDonald's or Burger King, they're going to Chipotle now because at least they know that there's a lot more fresh ingredients. And yes, Chipotle has a lot of salt and there's high calories, but at least most of the ingredients in general are fairly healthy and they're using, non-genetically modified non-genetically modified stuff to a certain extent, because there's just not a lot of long-term research on the GMO stuff. We don't know for sure or not. And I've heard some people say, oh, the GMOs, right, they're not the healthiest things in the world, or there's no proof that the GMOs cause cancer or anything like that, and human beings have been doing it for thousands of years, genetically modifying different plants or animals, or to make different puppies and things like that. We've been combining breeds of plants or animals. Well, we haven't been taking reptile DNA or amphibian DNA and injecting it into a plant. So I think if it's similar species and we're doing that with plants or animals, to make a different breed of a dog or something like that, or a different breed of a cow like a beefalo, that's probably a lot safer, I think, than injecting animal DNA into a plant. There's not been long studies about this, about the health ramifications of this. So anyway, though, that's kind of off tangent. So back to the value traps. McDonald's has a lot of work to do to turn things around. So they are coming out with some premium chicken sandwiches, which is probably a little bit healthier and more normal chicken sandwich that you would get if you went and bought a boneless, skinless chicken breast in the grocery store, and you marinated it or spice rubbed it or both, and then you grilled it out yourself and made it. But in order to win those consumers back, the people that left McDonald's or haven't eaten there in years, it's going to take a long time, a lot of work, a lot of money. It's going to take a long time to change people's minds. So they're just in such a competitive industry right now with fast casual. I think they could go the way, obviously it's not going to occur in the first couple years or 5 years or anything like that, but they could eventually turn into, a Kodak. And Kodak is another example of a value trap. Kodak looked very cheap for a while. They had access to the bond markets, and they were able to, keep buying back shares and paying dividends and things like that. And this is while digital photography was destroying their film business, was destroying their regular camera business. And, they just didn't adapt that well. They knew about digital photography, Kodak did, and they just didn't adapt that well to how the world was changing around them. But Kodak is a technology company. So in general, a lot of value investors, some of them don't like technology companies, some of them do, some of them don't. But Kodak was the type of technology company where, they had their film business and their camera business, and that was pretty much most all of their business. And, the thing about technology companies, and this is why Warren Buffett doesn't necessarily like most of them, is often they have to bet the whole company on one product. So they have to spend, hundreds of millions or billions of dollars in research and development. And maybe it's going to be a good product, maybe it won't. I mean, maybe you've tested it out, maybe not. I mean, there was no guarantee that the iPod or the iPhone or the iPad was going to be as good a success as it was. Steve Jobs he took risks, calculated risks, and they worked out really well. But there was there was other companies who did try to release, some of these products early, but they didn't have the right, market with the iTunes store and all the other apps. I'm forgetting the right word. I think it's the ecosphere. Yeah, the right ecosystem. It's the right ecosystem. Excuse me. The right ecosystem with the products to combine that. So, that's why a lot of value investors in general don't like most technology stocks is, if it's a case of like a car company that's cheap, like a General Motors or a Ford or something, they have to retool their factories every few years or almost every year, and they have to spend hundreds of millions or billions of dollars to retool their factories. That's high capex. That's almost like a mining company in terms of the capex, so they don't like that. They like a durable competitive advantage, a consumer monopoly, an economic moat company that doesn't need to spend hundreds of millions or billions of dollars and bet the whole company on one thing and can more easily generate free cash flow. So McDonald's used to be a company when the brand was more trusted that could more consistently generate free cash flow. They're still generating some now, but they're closing so many stores in the United States so rapidly, it's very clear that U.S. consumers don't really trust the brand that much anymore. Maybe, there's a small amount still, but their same-store sales growth is negative here in the United States, and I think the evidence is clear that, most of the McDonald's sales are not really in burgers and fries. I think they're selling a lot of coffees, maybe a little bit of breakfast here or there, but, they're not, their core business used to be burgers and fries, and that's hurting them real bad because they're not doing that business very well anymore. Coca-Cola as you guys know, used to only sell sodas, but Coca-Cola, I think, has actually adapted pretty well to how the consumer's preferences have changed more than McDonald's has. Coca-Cola has adapted to, water and vitamin water, which is, flavored with stevia or Truvia, and healthier beverage options with less calories and less sugar and no high fructose corn syrup. So I think Coca-Cola is adapting better than McDonald's has. McDonald's has resources to do this turnaround and fix things, but I don't know if they're going to be able to successfully do it or not. So even though you're getting that dividend yield with McDonald's, there could be large capital gains losses as they can't beat earnings and revenue. They have to close more stores, etc., etc. There was rumors about this with Hershey's chocolates that they were a value trap after 2008, 2009 when they had some problems. But I think Hershey's has done a better stewardship of protecting their brand than McDonald's has. I think, with the documentaries that have come out, I think McDonald's has not done a good job of trying to get in front of these things and show, we're going to have a lot healthier food on our menu for people at an affordable price, and we're going to offer a lot higher quality stuff at a good price that can compete with fast casual restaurants. And there's just so many more fast casual restaurants. It seems like there's so many new burger joints and so many new, there's fast casual pizza that's opening up that's going to hurt Pizza Hut, and it's going to hurt McDonald's. And, these things are all coming down the pipe. So McDonald's once monopoly that it used to have with the national highway system, those days are, very much over, especially in the United States. And I think McDonald's is, in this market, is very tough to find something paying a dividend unless it's in a natural resource sector that's selling at 9, 10, 12 times earnings. But in general, a lot of stuff with the dividend now is selling that, as long as it's a main conventional brand like McDonald's is, because it's such a well-known brand, is selling at 18, 19, 20 times earnings. So I think McDonald's is a value trap. I think the yield is a trap. And I think they're gonna struggle to change the consumers over to trying them again. There's just too much competition, and they've cut so many corners with all these chemicals and all these other things for so long. And now the rest of the video here I wanted to do was just about where else I see value investing ideas. In terms of value still, obviously oil is not as cheap as it was a couple months ago. I had a lot of guests on. You can go back and listen to the Robert Rapier interviews, the couple of them I did in the last couple months, Elliot Gu interview. I think Elliot, I've been trying to get him back on. He actually said that oil would bottom around 40, so I think he nailed it perfectly. Trying to get him back on and get his thoughts on this. The oil has had a lot of short covering. There was a lot of people, everyone on Wall Street, their brother, all their hedge funds, they were all short oil. The chart looked bad, a lot of the fundamental stuff that was coming out, people who weren't paying attention to the right stuff were all seeing negative news on the fundamentals. So everyone was short oil. It was due for a correction. It was due for a mean reversion to start going back higher, And so oil is still cheap. There's a lot of bargains in oil if you know where to look. It's just not as cheap as it was a number of months ago. Obviously, if you bought the right oil stocks, if you hired Wall Street from Main Street for consulting, or you did your own research, or you bought Dan Steffen's oil newsletter, Energy Prospectus Group, which I think is great, you've done very well the last couple months in oil. But I still think there's value there. There's a lot of mergers and acquisitions picking up in oil. I think there's going to see more. Oil should probably be in a trading range. It may start going a little bit lower. I don't know if it's going to go to $45 like Goldman Sachs is saying by October, but if it starts heading back to 40, you're going to see a good amount of shale oil producers either give up, and U.S. shale oil producers either give up and sell out, or some of them are going to start to go bankrupt. There was not a lot of loan defaults because oil didn't stay at $40 for long enough or go lower than 40. But if it does again, the bank lenders may give up, and the board of directors of these shale oil companies may actually sell out because there would be breaches of debt covenants. There were starting to be breaches of debt covenants at 40, but they weren't down there long enough, so the oil companies were able to sell some emergency debt and equity. So there wasn't loan defaults from the banks holding them yet. But if we do go back down to 40 and test 40 again, that could definitely occur. But we're seeing mergers and acquisitions pick up. The smaller oil producers with the really good assets that were undervalued and were generating cash flow, like Pacific Rubiales and Mart Resources, those were two of my favorite smaller ones. They were taken out. They were bought at bargains, in my opinion. when the oil price does start going higher eventually, those companies, the assets that were bought at cheap, are going to do well. And there are the larger companies, I think, are starting that missed the shale boom. They are starting to look around at the valuations, kick the tires on some of the smaller ones. We've seen a number of $1 billion and $2 billion deals. We haven't seen anything larger than that really yet. So it's been mostly the mid-tier oil producers that have been taking advantage of these bargains, the ones that didn't have too much debt in their balance sheet, and now they're going out and buying assets at good prices. Gold and silver stocks are still extremely cheap. The best ones are still the royalty and streaming companies. Those are the big four. You guys know those. I talk about those. I think the European consumer stocks are like Nestle, some of those. I think those are very solid. Everyone's like, oh, Europe's going to completely collapse and stuff like that. And, maybe Europe does need to be fixed. The euro in the first place probably shouldn't have been started. It was a bad idea. Greece may leave. Maybe that panic causes European stocks to drop another 10, 15, 20%. If you have cash on the sidelines and you can pick up Nestle or some of these other quality European brand consumer companies that they have more reliable sales, and you can pick them up at a discount and pick up some dividend yields, you should. And there's also, developing country stocks like that. Although, China, it looks like China is going to have much larger asset bubbles besides just the real estate bubble, because it looks like Chinese quantitative easing with financial repression is coming down the pipe soon, too. China is about to get into the full financial repression game. It looks like they're going to force their state-run banks to start buying up massive amounts of municipal debt, because obviously, really bad central planning, hundreds of billions of dollars in bad central planning. And now those municipalities can't pay their debt, so the debts are going to be bought by the banks, the maturities are going to be extended, the interest rates are going to be forced lower. You guys are familiar with this if you pay attention to our channel and our videos with financial repression in Japan, Europe, and the United States. They're all trying to do this. It's ridiculous, but this is a world we live in now where everyone wants to do financial repression, and most people either don't care, don't have any money, or they're making money off the system, or they're stupid, and they're going to let this go for a while, at least longer, until the next financial system is in place. Other than that, there's not that many good values in technology. Sometimes a sector will start massively correcting, like 3D printing, although most of the companies in 3D printing are not really making any money. Only Triple D 3D Systems is. They missed on earnings and revenue. But I think in the long term, if you have a time horizon of a couple years, it's probably a good time to add some shares still, because they're doing a lot of good things with 3D printing. A lot of industries are going to be disrupted. Another company is Qualcomm. Qualcomm lost some important contracts, but they have a lot of stable revenues, but the thing about technology companies, guys, that's different than other ordinary value investments is that the technology company has to spend a lot of money on research and development, or they have to do an acquisition because the technology can be commoditized and the margins can be eroded. And you've even seen that with Apple, with competition. When 7 years ago, Apple didn't have nearly as much competition. Apple's not going to be growing nearly as fast. Apple's kind of turned into more of a value stock than a fast-growing technology stock. They're so big already, but they have more proven revenue streams, and they have a pretty decent dividend yield, and they're probably going to be doing more share buybacks and increasing the dividend and stuff like that. So Apple's more of a value play at this stages. I don't think you can expect massive capital gains every year or every couple years like what you were getting in the past with Apple. But that doesn't mean Apple's a bad company. It just means, if you're looking for large capital gains, you're in a short amount of time, you're not going to get it with Apple. So in general, guys, like just wrapping up this video now, I think I've laid out what the case for a value trap is. It's where, to summarize it very quickly, it's where the financials may look good. Maybe the company's selling at 10 times earnings. Maybe the company has a 5% dividend yield. So the numbers look good, but the financials may show red flags, or the underlying business, something drastically is changing, where the consumer doesn't trust the brand anymore, and the company's going to have to spend hundreds of millions or hundreds of billions of dollars trying to fix their brand and change their business model and stuff like that. And during these during these very expensive and time-consuming changes, it's like turning around a cruise ship or an aircraft carrier. It can be done, it just cannot normally be done quickly. You can't stop on a dime and turn it around and do a complete 180. And that's what McDonald's, in my opinion, is trying to do. They're trying to get back to the new consumer trend, which is healthier food, more nutrition in the food, more organic food. Maybe they can still put more higher calorie, but it has to be more grass-fed beef or things like that. And that's why you're seeing McDonald's on their new burgers here on their website. They're advertising, oh, it's 100% sirloin. Why would they have to advertise it's 100% sirloin? Well, they're going to try to make it look like it's either grass-fed beef or organic beef, or they're trying to convince consumers that, oh, there's no more pink slime in the hamburger anymore, or we didn't put any other fillers or additives or things, or the burger didn't sit around for 5 hours in a tin or something like that when we made it at 11 and now you ordered it at 4 p.m. and we served it. So this is what we're getting to here, and that's how you can avoid a value trap. If you have any other questions about it, just shoot us an email, wallstreetformainstreet@gmail.com. We have a dividend report out if you're interested. It talks about some undervalued dividend stocks in this market. There's just not a lot of them outside of the resource industry, really, or foreign stocks, because of the asset price inflation, all the global quantitative easing, all the global carry trades with the yen and so many other currencies in carry trade, that, these Keynesians are forcing asset price inflation because there's so much debt, and they're not allowing the assets to fall, and they don't view asset price inflation as evidence of inflation. So that's why I ask that question a lot, just get people's views, because for a while, whether you go back through financial history, pretty much the Keynesians have never, and this is decades ago, they never really counted asset price inflation as inflation. So I guess that's the good inflation. It's not really the good inflation in the long term, but they view it as the good inflation, I guess. Anyways, though, guys, hope you liked this video. Thanks again for watching.